Monday.com recently reported earnings and they beat on expectations. However, a weak guidance for the next year pulled the stock price down. In today's video, we want to quickly evaluate whether or not buying the stock at today's price could make sense. So let's look at the numbers. They made a revenue of $972 million in the last year with a $32.37 million in net income, which gives them a rather low profit margin of 3.3%. They're currently priced at $78, and this gives them a PE of 122 based on last year's numbers. However, keep in mind that their trailing 12 months net income is much higher, so the PE is currently sitting around 80. But that is, of course, still very high. So let's look at whether or not there's potential in this company. First of all, we're going to look at a bear case 5 years into the future. And they're expected to do around 20-ish% year-over-year growth. So I gave them a bit lower. Revenue growth of 50% for the bear case, assuming that competition gets more fierce and so on. Their profitability is expected to increase at least as high as they can get it. So I went with a bit lower than the estimated profit margin of 8% for the future. And their share count has been increasing steadily over the last couple of years. So for this case, we're going to assume that this behavior continues. And giving us a company in such an early stage AP is always a bit complicated. They're still growing, their earnings are often a bit all over the place. So evaluating or giving them just one PE can be a bit difficult. But I went with a PE of 22. It does not seem to be such a premium company, but it's still growing very steadily. So those were my thinking when giving them this valuation. And this would take the stock price to $53, which bought at today's price would mean an annualized return of negative 7.4%. But in contrast, let's look at a bull case, same 5 years. But this time a higher expected revenue growth of 22% per year and a higher profit margin of 12% and a bit lower share dilution of only 4% and a higher PE of a very solid 28. This would take the stock price to around $132 per share, which bought today's price would give them an annualized return of 12.86%. And if we combine these two cases, this would take the stock price to around $98, which bought today's price would give them a 4.66% return. So not looking all too crazy right now, at least with these assumptions. Maybe they are too low. Maybe the market sees something in the company that I'm not seeing. But being a little bit more on the conservative side, this company definitely does not meet my margin of safety at this current stock price. So I'm keeping it on my watch list, but if it doesn't go lower in price, then I wouldn't mind too much. But that's at least what I'm thinking about this company. Let me know if I have missed anything, and thank you for watching. I will see you in the next one. Bye.